Hello, happy tax students. This is Professor Marsh again, and this is the video for Chapter 10, Property Acquisition and Cost Recovery. This is about the assets that we purchase and use in our businesses and how we recover the costs. So just like your professors, things get old and they wear out. And how do we account for the costs and how much are we allowed to deduct from our income for the acquisition and the use of these assets from year to year. So we're going to talk about depreciation, we're going to talk about amortization, we're going to talk about depletion, but we're not going to talk very much about it because it's so darn complicated. And so what I've done in this chapter is I've just tried to highlight what I think are the most important points for you to remember going forward, and then just to point out some things that you might be surprised to hear. So really what we're going to do is we're going to focus on terminology, make sure that you know the process for establishing a tax basis in an asset, when you can expense an asset, when you have to set it up on your balance sheet and depreciate it, and how you do that. So we'll go through the high points of this chapter and then skip over some of the nasty picky detail that most of those calculations would probably be performed by a computer program if you were in practice as a tax accountant, or perhaps you might do it by hand on occasion if you had a particularly wealthy client who could afford for the tax accounting help to do that calculation for you. So anyhow, let's go ahead and take a look at Chapter 10. And in Chapter 10, we start with our buddy Steve Dallimore. And they were ice climbers, and Steve got caught in an accident into a snow cave. He had an epiphany about designing a better ice climbing tool, and what this chapter goes through is Steve's setting up of a business and acquiring the assets for that business, and then how he recovers the cost of that of those assets. So on the first learning objective deals with cost recovery and the tax basis for cost recovery. So in Exhibit 10-1, which is on page 10-2, you'll see a small chart, and what you'll find is that we have the different types of assets and the cost recovery method. And so personal property, tangible personal property, such as automobiles, equipment, and machinery, the cost recovery method that we use is called depreciation. For real property, buildings and land, and the book does note that land is not depreciable, although I could show you how to depreciate land if you really wanted to depreciate it. I know a few tricks there. The real property cost recovery method is depreciation. And then intangible assets or non-physical assets such as goodwill and patents, and we recover those costs through amortization. And then natural resources, commodities that are considered valuable in their natural form, oil, coal, timber, gold, we recover those through depletion. So those are the different types of basic methods. And then in Exhibit 10-2, you have a set of information that was taken from the Weyerhaeuser Corporation. That's a big timber company. They have operations around here and around the world, and they have $2 billion in property and equipment and $11.8 billion in timber. And you can see their listing of assets on their Form 10-K that they filed with the Securities and Exchange Commission. And this is for the years 2020 and then the previous year, 2019. And what you can see is that they've got total assets of about 16.3 Previously it was $16.4 billion, but they have recovered some of the costs, at least $100 million thereabouts during the year 2019 to 2020. And you can see the different asset categories and how they go up and down, up with purchases and down with depreciation and dispositions. Okay, the tax basis of an asset is something that you'll have to determine, and typically if you're purchasing assets, then the tax basis is going to be the cost, perhaps plus some in addition to the price of the asset, if there are other costs, transportation, that are capitalized into the purchase price, things of that nature, shipping. You might have some additions, and then the tax basis is usually the beginning number in which we calculate what kind of cost recovery that we're going to use. And as we recover the cost, the basis changes. The tax basis of the asset changes from year to year or period to period as we recoup some of that cost through depreciation or other cost recovery deductions. And so as that basis changes, it's called the adjusted basis, and that just means the purchase price less all allowable deductions against the purchase price for depreciation or amortization or depletion. Now, if a business discovers that it hasn't claimed allowable depreciation in a previous year, well, what can it do? Well, it can actually make a change in accounting method to recover that depreciation, and that's discussed in a footnote 3 on page 10.10-3 of your book. Also, a business, just because it acquires an asset, doesn't get to depreciate it immediately. It only gets to depreciate the asset when it places it in service. So, for example, if I wanted to call attention to my law practice by buying a James Bond styled Aston Martin and try to throw off some aura of sophistication or international savvy, then if I bought the Aston Martin and put it in a garage and didn't show it to anyone for several months, I wouldn't get to take any depreciation for it because it hadn't been placed in service. But then if I parked it out in front of my office or used it in a commercial or something of that nature, then it would be placed in service, and then the depreciable period would begin. Anyhow, those are some things about acquisition and placing in service. And you see a little box on 10-3 which has some key points about initial basis and some of the rules for both book and tax accounting. What you'll notice in the book is that there are some choices about whether to, when you acquire an asset, do you have to capitalize it? There are some capitalization rules that are built in to the tax code that are very, very complicated. They're discussed briefly at the bottom of page 10-3, carrying over to page 10-4. The book notes that the regulations cover over 200 pages and are extremely complex and really something that only people who specialize in this very small area of the tax law know a lot about. And so my recommendation is that you just understand that you have to have a capitalization policy, and a lot of times it's a rule of thumb. Anything up to $2,500 per invoice can be expensed. Anything above the $2,500, perhaps you've got up to $5,000 that you could expense, and then once you go above that, you probably are above your de minimis requirements, and you have to capitalize those assets that are more expensive than those relatively small amounts. So anyhow, just understand that there's a capitalization policy that you're supposed to follow, uh, and so you can't just write off everything, including the kitchen sink. Now, as we'll see, there are exceptions to that capitalization policy, and there are things such as Section 179 deductions and bonus depreciation that a lot of times can get you to the same result as if you had just written off the cost of those assets. And it doesn't apply to everything across the board. The IRS is and the Congress is very concerned about luxury automobiles and assets that have personal use as well as business use to them, and so there are limitations on all that too. It's a very complex chapter, very long chapter, and something that we probably can just kind of skim the surface of, and you can learn enough for purposes now. And if you decide to become a tax professional, then you can get more detail about this when you take tax accounting, or perhaps a course that is specifically about depreciation and cost recovery. And of course, you'll learn about that too in financial accounting. They spend a lot of time on depreciation in both principles and also intermediate. So you'll find it over there too. Okay, let's look at example 10-1. Just note that there is a listing of the various items that Steve is purchasing and his purchase price, and so you can see there's some business preparation costs for some of those that get added to the basis. And you can see how that's done. And what if he acquired a printer for $800 on July 9th? Would he immediately deduct the cost of the printer or capitalizing it? And assuming he has a policy to expense items costing $2,500 or less for non-tax purposes, he'd be able to immediately deduct the cost of the printer under the de minimis safe harbor. So there we go. Okay, then on page 10-5, what if the business has an annual safety certification and they find there's a defect in the engine blade of one of the machines, and he's got to replace the engine blade. The cost is $3,000. Can he immediately deduct the cost of the new engine blade? And assuming that he does it with a commercially available and comparable part, he can deduct the $3,000 cost of the new engine blade. So that's Steve and his engine blade. Okay, what about gifts and inheritances? What if these are assets that you're using in business that you didn't purchase, but that you received as a gift, perhaps from another family member or from a friend, or as an inheritance? Well, if you receive the gift, if the donor is alive when they give you the asset, then their tax basis becomes your tax basis. It is you have a transferred basis from the donor to you, and so even if the asset is worth $45,000, as the book suggests, but the donor had a basis of $25,000 in it, then you would get a $25,000 beginning basis, and that would be your beginning basis for depreciation if you used it and placed it in service for business. If you inherited building worth $90,000 from your grandfather, who originally paid $35,000 for it, the basis would be $90,000. That's called a step up in basis, and so you get a fair market value basis at the date of death when you acquire property through an inheritance. So if the donor is dead, that's sad, but you do get a tax benefit for that in most cases with inflation, and especially the way inflation is nowadays. You're going to get a pretty substantial step up because of the decreased value of the dollar. You have an ethical consideration in the middle of page 6 in chapter 10, and Catherine Travis is starting a new business, She has several assets she wants to use in her business that she'd been using personally. Because she plans to convert several assets from personal to business use, she will need to find out how much each asset is worth so she can determine her basis for depreciating the assets. Catherine has decided that getting an appraisal would be too costly, so she simply uses her cost basis in the assets. Well, Catherine has not followed the correct way to get to the right result, but she has gotten to the right result. She's stuck with her cost basis for the assets. She doesn't get to write things up to their fair market value just because she converts them from personal use to business use. So Catherine has a very bad logic, but very good strategy for setting up the basis of her business assets. And she is required to use the cost that she acquired them for. So there we go. Okay, second learning objective deals with depreciation. And what we learn is that in order to calculate depreciation, you have to know four things. You have to know the original basis, the depreciation method, the recovery period, and the depreciation convention. Now, the depreciation convention is not a party at a hotel where you talk about depreciation. The convention is the method that you're going to use to calculate the depreciation. So under the tax law for the last, almost 40 years, since 1986, what's that, 36 years, businesses have calculated their the depreciation using MACRS, M-A-C-R-S, the Modified Accelerated Cost Recovery System, which is pronounced MACRS by tax accountants. And as a tax accountant, I swear to pronounce it MACRS. So it's a special type of depreciation method, complicated as heck, lots and lots and lots of rules and lots of exceptions to the rules. But basically, it's the system that we use that determines the recovery period for both personal and real property, and it's in the tax law. So if you were going to have to do this for real, you would have to go to the various charts, and there are some charts in the back that have the MACRS calculations and percentages spelled out for you if you do have to do those calculations. So it takes you year by year through what percentage of the cost of the property do you get to deduct under MACRS. In Exhibit 10.3, you have an example of some of the different depreciation recovery periods. This is from Revenue Procedure 87-56, which is a very long revenue procedure and very specific one. And you can see that the classifications for office furniture, fixtures, and equipment, they have a class life of 10 years. They have a general recovery period of 7 years and an alternative recovery period of 10 years. And as you can probably tell from the small print and all the different numbers and the different methods, this is just complicated beyond belief. But in any event, you can look it up when you need to find it out. The recovery period for most common business assets, that's set forth in Exhibit 10-4 on page 10-9. And what you can see is that cars, light-duty trucks, computers, peripheral equipment, they have a recovery period of 5 years. Office furniture, fixtures, and equipment, 7 years. And then qualified improvement property, 15 years. And those are the most common types of business assets. And so then you see an example of how our hero, Steve, the ice climber, sets up his assets that he's purchased with his cost basis and his recovery periods. And you get the references back to, how he determined those particular recovery periods for the office furniture, the machinery, and the delivery truck. Just keep in mind that with respect to cars, even if the recovery period is only 5 years, if you're under the luxury car rules, if you did buy that James Bond Aston Martin or a Maserati or a Ferrari or something, you're probably going to have some. There's an example of a Porsche that's in here later. You can have car depreciation that lasts much longer than the useful life of the car because of the limitations on depreciation for luxury cars. So you might only get $5,000 a year, for after the first year, you might get like 10 or 20,000 the first year, but then after that, you might be stuck with $5,000 a year for the next 20 years for your $100,000 plus car. So, okay, there's a bunch of stuff in here about conventions, half year and mid-quarter conventions. This stuff is just way too complicated, and we're just going to skip right through it. So just understand that the tables that are in the back of the chapter are based on certain types of depreciation that you probably learned in financial accounting, double declining balance method and things of that nature. It's just that so many taxpayers have so abused these in the past, and Congress, every time that happens, the IRS goes running over to Congress and says, help us, people are deducting too much and getting too much tax benefit. And then either Congress or the IRS will issue a statute in the case of Congress, or a regulation in the case of the IRS, which attempts to right the ship and put people back on what the government considers kind of a fair method. Okay, so real property depreciation is discussed on 10-14, page 10-14, and the recovery periods for real property and other common business assets and investment assets are set forth in the box at Exhibit 10-7 in the middle of that page on page 14. So for residential property, the recovery period is 27.5 years. For non-residential property placed in service on or after May 13th, 1993, it's 39 years. And for non-residential property placed in service after 1986, but before May 13th, 1993, it's 31.5 years. May 13th, 1993 is an important date. That was the date that the Clinton tax increase passed. Remember, Bill Clinton said he raised taxes too much, and one of the ways that, and he did actually eliminate the deficit during his term as president, but one of the ways that they reduced the deficit and earned a surplus was by lengthening the lives of non-residential property and restricting the amount of depreciation deductions that investors could take. So kind of a hidden tax increase in that tax bill. And May 13th, I guess, was the date that it either passed or was introduced in Congress. I've forgotten, but it was one or the other. And then, of course, in 1994, after they had that big tax increase in the first 2 years of the Clinton presidency, then the Republicans won about 70 seats in Congress, and Newt Gingrich became Speaker, the first Republican Speaker, I think, since FDR was president. So a long time. Okay, so the key facts regarding real property depreciation, this is the box that's in the margin on 10-14, is real property is depreciated using the straight line method. They use the mid-month convention. That assumes that all real property is purchased the middle of the month, so you get a half a month for the first month. Residential property has a recovery period of 27.5 years, as we've said, and it was in that little chart. Non-residential property placed in service on or after that date in May 1993 has a life of 39 years, and non-residential property purchased between 1986 and 1993 has the date in 1993 has a recovery period of 31.5 years. And that's that. And then on page 10-15, there's something about cost segregation, and you're probably thinking, segregation, that was abolished by the Civil Rights Act. Well, that's not the kind of segregation that they're talking about. What they're talking about is a special type of method of calculating depreciation on real property by treating some of it as personal property and greatly reducing the useful lives of some of the costs of this real property. So the book gives you an example of a strip mall that you purchase for $1 million. The taxpayer purchased it for $1 million, and if you just took 39-year straight line depreciation, after 5 years, the taxpayer would have $114,000 and change in depreciation deductions. But cost segregation involves the use of appraisers and economists to identify various features of a property. Perhaps this door that's behind me, they might say that door is worth $1,000 or something out of the price of the house. And so we're going to recover the cost of that door over 5 years instead of the 39 years. And the light fixtures that are in here, they aren't very good. It's a little dark, but anyhow, we would maybe say they're worth $2,000, and we're going to recover those over 5 years or 7 years instead of the 39-year useful life of the whole building. So taking those additional deductions, as the book suggests, can give you a huge increase in depreciation over the first 5 years of the useful life of the property. The book example allows you to recover out of that $1 million $512, almost $513,000, over half of the $1 million purchase price, by using the cost segregation analysis and method. So a very useful thing to know for planning in real life. Okay, let's go on to page 10-17 and special rules relating to cost recovery. And the first one that we're introduced to is the immediate expensing election under Section 179. And so this is an election that a taxpayer can make to elect to immediately expense up to $1,080,000 per year in qualified property placed in service during 2022. And you can see that that's calculated and discussed in the context of Steve's company, Teton Asset Acquisitions, and they've purchased computers and information systems of $920,000, and a delivery truck of $80,000, and machinery of $1,200,000, and so a total of $2.2 million in total asset acquisitions. And if you look on the following page, what you'll see is that they can make some elections. In the first example, in example 10-11, you're electing to just immediately expense $800,000. Now, Teton could have taken the whole $1,080,000, but in this example, they only take the $800,000 of the machinery that they want to immediately expense. So they take the $800,000 deduction for the 179 expense. They have a remaining basis in the machinery of $400,000, and then the rate for the first year maker's depreciation rate for 7-year machinery is 14.29%. You can see that in Table 1 at the end of the chapter. And so you get another $57,160. So your total depreciation is $857,160. Steve's going to get a pretty big tax deduction. He's probably not going to owe any tax. And if he wanted to take the full amount, he could have done that, and that's in the second example that's in that same box, where you take the $1,080,000, the maximum that you can expense in 2022, but you still get to depreciate the remaining $120,000 that's left over at the maker's rate. So he ends up with almost $1,001,000 in total depreciation on the machinery in the first year, which is pretty heroic, especially if he financed that machinery. If he borrowed 80% of the cost and just put 20% down, maybe $240,000 down, he gets a $1,001,000 tax deduction. That's like one of those old tax shelters. I mean, that's a almost 5-to-1 write-off. So anyhow, pretty good deal. Limits on immediate expensing. There are limits. There's a phase out if you have too much qualifying property that you purchased during the year. Once you go above 3,780,000, then the maximum 179 expense for the year is zero. So it phases out for larger businesses. This is a benefit that's only really intended to benefit smaller mom and pop businesses, not your big public companies and that sort of thing. And it's per return too. So if you have multiple businesses all acquiring recoverable cost type assets, and the limitation applies at the taxpayer level, and you have to parcel out that $1,080,000 among the various assets that you've acquired in all the different businesses that you own. On page 10-19, there is a box that summarizes basically what you need to know about Section 179 expenses, what I've just said. And then there's also a discussion at the top of page 10-20 about choosing the assets to immediately expense. And the book suggests that for tax planning, if you're trying to get the maximum allowable deduction, then what you want to do is you would want to expense the assets with the lowest first-year cost recovery percentages under makers to get the bonus depreciation and get, to get the maximum expenditure of those assets that are slowest to be recovered under makers, and then keeping the assets that you can recover the fastest under makers under the makers method. So if you have to choose which assets to pick for the $1,080,000 179 expense election, you want to pick the assets basically with the longest lives and the slowest depreciation rates. And you can see an example of that in example 10-14. So then there's also this thing called bonus depreciation. And this basically says you can just write off everything. And this was part of the Trump tax cut back in 2017, which increased the bonus depreciation, which had ranged around 30%, 50%, and right before the tax cut in 2017, the rate was 50%. That increased it to 100% for the last 5 years, and then it phases out until it's down to zero in 2027. You can see that phase out in Exhibit 10-9. So bonus depreciation, basically says anything goes, and you can write off anything that you acquire under bonus depreciation. So why do all these rules matter? Well, they will matter at some point when the tax code recovers from all the little gimmicks that we put in over the last few years. Okay, then there's this thing called listed property. Listed property is property like your cell phone, your personal computer. Maybe you use it partly for business, partly for personal purposes. Of course, the computers and cell phones are exempted from the listed property rules and having to keep track of them. But things like your car that you drive personally and for business, you're supposed to keep a log of what the business use is, and you can take that percentage of the business use times your costs for operating it as a deduction, or you can take a IRS approved per diem for some of these costs, or you can just take your direct expenditures if you can track those. Which tank of gas was for business and which one was personal and that sort of thing. That's kind of a tough task from an accounting standpoint, but in any event, you do have to, for this listed property, you do have to make an allocation of your expenses. And if you go under 50% business use, there are some rather restrictive standards that you're forced into. And if you've been taking an accelerated method of cost recovery, you have to switch it back to straight line. The discussion of luxury automobiles is on page 10-25. You've got the limitations in depreciation deductions, and you've got a box that also talks about what a luxury automobile is. If a vehicle has a 6,000 pound weight, then it is not considered a luxury automobile, even if it's a very luxurious Escalade or something like that, or a really luxurious truck that you could maybe live in. It's going to not be subject to these restrictions. There's also in 2022, in addition to the amounts that are permitted in the box that's Exhibit 10-10, there's also $8,000 of bonus depreciation allowed on vehicles too, and you can see that discussed in example 10-19, which is on page 10-27. And the comparison of the Honda Civic at $19,150 to the Porsche 911 at $112,000 is shown on example 10-18. And as you can see, the owner of the Porsche gets a pretty good deduction in the first year, but is still going to be recovering that cost 16 years later because of the restrictions in the tax code. Okay, let's see here. On Exhibit 10-11, there is a summary of Teton's, Steve's company's depreciation expense, and it's got the references back to all the different examples at which they were calculated, and you can see that Steve is getting total depreciation expense of almost $2.4 million, which well done, Steve. Hopefully he's got enough income to offset that. And his depreciation schedule is shown on the next page, on page 10-30. It's all filled in, and with the exception of his Social Security number or identifying number for the business. So if you were preparing this, you would want to make sure that you had the EIN for that particular LLC listed on the form. And you can see how they've completed it and how it's reported for tax purposes. And this is depreciation. So we finished the depreciation section. Now we're going to go on to the next learning objective about amortization. And amortization is important for a number of intangible assets. One is section 197. So we had 179 for depreciation. Now we have 197 for amortization, and it's for purchased intangibles, and it allows you to recover purchased intangibles, goodwill, and other types of intangible assets to recover those costs over 180 months, which is 15 years straight line. And then there's organizational expenditures and startup costs, and those are typically recovered over 60 months. And then you've got research and experimentation costs, and you've got patents and copyrights. And so those are all examples of assets that are amortized, and the rules for intangible assets are set forth in this section of the materials. Just understand that startup costs, generally speaking, are a lot less than what you see in the book. If somebody wants to start up a company and is willing to pay $5,000, I'm happy to be your attorney. Okay, we typically charge a lot less than that to our clients, and certainly a lot less than $50,000, which are the startup costs that are discussed in the boxes in kind of the beige color on page 10-33 and continuing on for a couple pages. So there is a phase out if you're if your startup expenses go over $55,000, you don't get to take any of them immediately. You have to just recover all of them over the 5-year period. So anyhow, that's that's the rule about that. I'm sorry, did I say 5 years? I meant 15 years. So 15 years, not 5. And you see in Exhibit 10-13, you've got a summary of the timing for organizational expenditures, startup costs, and normal trader business expenses. So when the investigation into the new business starts, you've got some startup costs and organizational expenses under Section 195 and 248 of the tax code, respectively. And then when the trader business actually goes live, when it opens its doors, then you've got trader business expenses, if they're ordinary and necessary, that are deductible under Section 162. Patents and copyrights are discussed on page 10-36. You can see that, and then you get to depletion on page 10-37, and depreciation involves a calculation of both cost depletion and percentage depletion, and taxpayers are allowed to take the larger of the cost or percentage depletion as a deduction on their taxes each year. So you can see how that works. We don't get a lot of depletion issues around here. I guess there could be depletion deductions for timber, but I think most foresters are calculating the actual value of the timber and using that as cost of sale as opposed to just some sort of depletion calculation. So that's it for Chapter 10. There'll be another lecture that discusses the homework, but have a great day and keep up in your reading, and we'll see you in Unit 11. Thanks. Bye.